Imagine running a business where your top line revenue is just rocketing up by nearly 50% year over year.
Right, which is huge.
Yeah, I mean, your customers are buying more frequently, your user base is expanding across the entire continent, and, your market share is quietly suffocating your competitors.
Best case scenario, basically.
Exactly. But alongside that spectacular growth, your operating margins shrink down to the single digits.
Ouch. Yeah, that's the catch.
Right. And if you look at traditional Wall Street trading desks, I mean, that combination usually gets a management team fired, or at least heavily scrutinized.
Oh, absolutely. You sell the stock and you ask questions later.
Exactly. But with MercadoLibre, ticker symbol MELI, and their Q1 2026 earnings, doing that might actually mean walking away from one of the most brilliant strategic land grabs we've seen in modern retail.
It really is.
Welcome to Talk Tickers. For this deep dive, we are bypassing the Wall Street noise to break down exactly what's happening under the hood here.
Because, we are looking at a classic contradiction today. Investors see that 6.9% operating margin, and their knee-jerk reaction is to assume that costs are spiraling out of control.
Right, or that the company has lost its pricing power because of all the competition.
Exactly.
My mind immediately goes to the old building a toll road analogy.
Oh, yeah, that's a good one.
Right, because if you only look at a toll road company, during the 3 years they are pouring millions of tons of concrete, they look like a terrible business.
Just hemorrhaging cash.
But then, the concrete dries, and they spend the next 40 years collecting $3 from every single car that passes by.
With almost zero additional capital expenditure.
Right. And that's when you realize the brilliance of the model.
And that is the exact framework required to interpret these Q1 results for anyone listening right now. MercadoLibre is, they're pouring concrete across Brazil, Mexico, and Argentina.
All at the same time.
All at the same time. And they're doing it simultaneously in e-commerce, logistics, and digital banking.
So our mission for this deep dive is to bypass the surface level panic over that 6.9% margin and look at the actual unit economics underneath.
Because the underlying data suggests they are knowingly suppressing their own profitability today to lock in a continent-wide ecosystem tomorrow.
Yeah, let's start by laying out the headline numbers that triggered this whole debate. I mean, the revenue beat was nothing short of exceptional.
It was massive.
Net revenue for the quarter hit a 49% growth rate year over year.
Which is wild.
It's totally anomalous. For a company operating at MercadoLibre's scale in 2026, putting up a 49% growth number is, management themselves highlighted this is their strongest revenue growth rate since the second quarter of 2022.
Right. And you also have to consider the macroeconomic context of where that growth is actually occurring. The performance is highly distributed.
Meaning they aren't just relying on one country doing well.
Exactly. We are seeing gross merchandise volume GMV surge across distinct, highly varied economies. Brazil was up 38%.
Wow.
Chile, which is historically a more, mature and stable retail market, was up 40%. Mexico up 28%.
And what about Argentina? Because that's always the wild card, right?
Yeah, Argentina presents a uniquely volatile inflationary environment, but they were up 41%.
So they're firing on all cylinders across the map.
They are.
Yeah.
They are definitely not reliant on a single market propping up the rest of the continent.
And the e-commerce side is, it's only half the ledger. The FinTech side, Mercado Pago, is accelerating just as fast, if not faster, actually.
Oh, the FinTech numbers are staggering.
Right. Monthly active users grew 29%. Assets under management jumped 77%.
Yep.
But the metric that really forces you to pay attention, I think, is their credit portfolio. The total amount of money they are lending out nearly doubled.
It grew 87% year over year.
To hit $14.6 billion. That's billion with a B.
Which brings us directly to the margin squeeze. You have the e-commerce engine humming, the credit portfolio expanding by 87%, but
income from operations came in at $111 million.
Right, yielding that compressed 6.9% margin.
See, if I'm a retail investor looking at a mature titan dominating its sector, printing its best top-line growth in 4 years, and I see margins compressing to 6.9%. My immediate skeptical hypothesis is that they are buying this revenue.
Meaning what, exactly?
I assume they are having to spend wildly on marketing or heavily discounting their own products just to keep the growth narrative alive for investors.
Oh, I see.
Because a shrinking profit margin in a high interest rate environment typically signals a bleeding core business, right?
Yeah, it's a completely rational suspicion. If they were simply throwing promotional dollars at the wall to juice top-line sales, that 6.9% would be a red flashing light.
A giant red flag.
Exactly. But when you look at the operational data, the cost to serve metrics and the loan provisioning mathematics, a totally different picture emerges.
Okay, so peel back the layers for us. What's the story behind the numbers?
Well, the margin drop is entirely calculated. It's a feature, not a bug. They are reinvesting their cash flow directly into user acquisition and structural lock-in.
So they're playing the long game.
Very much so. And we can prove it by looking at the e-commerce catalysts first, specifically their strategy around free shipping.
Right. They made a really aggressive tactical move in Brazil this quarter.
They did. They lowered the free shipping threshold to just 19 reais.
19 reais. I mean, to put that in perspective for you listening, 19 reais is a remarkably low hurdle.
It's practically nothing.
Right. You are moving away from consumers waiting to bundle their electronics or apparel purchases, and you are inviting them to buy like a single tube of toothpaste.
Or a cheap phone charger.
Yeah, a phone charger, and get it delivered for free.
And behaviorally, that alters the consumer's entire relationship with the platform. MercadoLibre stops being a destination for planned purchases.
And becomes a daily utility.
Exactly. You eliminate the friction of the checkout cart. The consumer doesn't pause to think, is the shipping worth it for this small item? They just click buy.
And the volume data reflects that behavioral shift immediately, right? Items sold in Brazil accelerated to an incredible 56% growth rate.
Yeah, and management pointed out that this 56% figure is more than double the quarterly item growth rate they were experiencing before they instituted the 19 reais threshold.
So the demand elasticity is clearly there. If you lower the barrier, people buy way more stuff.
Without a doubt.
But this circles back to my skepticism. If you are suddenly shipping 56% more individual low-margin items like that single tube of toothpaste, and you are footing the bill for the delivery to keep it free for the consumer.
Your logistics costs should be cannibalizing your balance sheet.
Exactly. It sounds like a logistical nightmare that would destroy your margins.
That is the exact assumption Wall Street made. And it's where the operational advantage of MercadoLibre's proprietary logistics network, Mercado Envios, becomes the real focal point of the quarter.
Okay, break that down.
So despite taking on a 56% surge in package volume, their shipping costs per unit actually dropped 17% year over year in local currency.
Wait. Volume goes up 56% and the cost to ship each item drops 17%.
Yes.
See, my first instinct when I hear that is that they are like squeezing their labor force or relying on gig economy drivers who are underpricing their routes.
That's a fair guess, but no.
So knowing the capital they've invested into automated fulfillment centers, is this actually a routing algorithm story? Are they simply packing the delivery vans tighter?
You're touching on the right mechanical concept with route density. It is an algorithmic advantage, but it's specifically about how they are managing what they call slow shipping idle capacity.
Idle capacity. Okay, let's trace a package to understand the mechanics here.
Sure. So in a standard logistics network, you build infrastructure to handle your peak demand. Let's say a Friday afternoon rush.
Right.
The problem is, on a Tuesday morning, that same infrastructure, the sorting machines, the warehouse staff, the delivery trucks, is sitting partially idle.
But you are still paying the fixed costs for the warehouse lease and the salaried managers.
Exactly. You're paying for it all, but fewer packages are moving through.
So you're just burning capital on underutilized capacity.
Right. So MercadoLibre engineered their system to identify those specific lulls across every node of their LATAM supply chain.
Ah, I see where this is going.
When a consumer buys that 19 race item, the system offers them free shipping, but the algorithm might route that package through the network only when there is idle space.
So it's not going on the premium overnight truck.
Exactly. The package fills the 20% empty space on a truck that was already scheduled to drive to Rio de Janeiro anyway.
Because the fixed cost of that truck driving to Rio is already accounted for.
Yes.
So tossing an extra phone charger into the back costs them almost nothing on a marginal basis.
Exactly. They are monetizing their own operational white space. The algorithm ensures the package arrives within an acceptable time frame for the consumer, perhaps 2 or 3 days instead of overnight. But the cost to MercadoLibre drops precipitously.
Wow.
That is how you increase volume by 56% while driving unit costs down by 17%. Higher volume is actively diluting their fixed costs.
That reframes the margin drop entirely. They are sacrificing top-line margin to fund the 19 RIA's free shipping, knowing it drives immense volume.
And that volume feeds their routing algorithm and drastically lowers their logistical floor.
Right. But the free shipping threshold wasn't their only lever. We need to talk about their take rates, because they deliberately suppressed their own revenue here too, right?
Oh yeah. The take rate strategy is one of the more ruthless competitive moves they discussed on the call.
And for anyone who isn't familiar, the take rate is basically the percentage MercadoLibre keeps from every third-party merchant sale.
Right, it's their commission.
Yeah.
And this quarter, they selectively lowered those fees in specific categories across Brazil.
Which, again, looks like they're bleeding themselves.
But the chief operating officer, Ariel, made it clear this was not a blanket charity move for sellers. It was highly conditional.
Right. Sellers only benefit from the discounted fee if they maintain the most competitive pricing on the internet.
It is a brilliantly designed forced price war.
A forced price war.
Yeah. MercadoLibre goes to a merchant and says, look, we will cut our commission from 15% to 10%, giving you a better margin. But in exchange, your listing price must be lower than anything a consumer can find on Amazon or Shopee or Magalu.
So the merchant is essentially bribed into passing the savings directly to the consumer.
Exactly. MercadoLibre takes a small hit on their commission percentage, but they guarantee they have the absolute lowest price in the market.
And when you combine the lowest price on the internet with a 19 RIA's free shipping threshold,
the flywheel spins out of control.
Yeah.
Unique buyers hit record highs, live listings surge, and the purchase frequency accelerates.
And this is why looking at the 6.9% operating margin in isolation is so dangerous for a retail investor.
Very dangerous.
The e-commerce margin drop isn't a result of inefficiency or bloated corporate overhead. It's the cost of a highly weaponized strategy to dominate market share.
They are aggressively taking margin away from themselves to squeeze out competitors, knowing their logistics network gets cheaper the bigger it grows.
So the e-commerce strategy accounts for a portion of the margin compression, but the FinTech side of the house, Mercado Pago, is actually driving the majority of this accounting hit, right?
Yes, a massive portion of it.
We mentioned the credit portfolio hitting $14.6 billion earlier. A huge driver of that growth was the issuance of 2.7 million new credit cards in a single quarter.
Which is an insane pace of issuance.
And the total payment volume on credit cards grew by 90% year over year.
And issuing 2.7 million credit cards in 3 months triggers a very specific punishing accounting mechanism that retail investors often misinterpret.
Yeah, let's get into this because this is crucial. The chief financial officer, Martin, stated plainly that 2/3 of the margin compression this quarter came directly from their loan book growing at 87%, while revenue grew at 49%.
Right.
Let's translate the mechanics of loan provisioning for you listening. When a bank, or in this case Mercado Pago, issues a new credit card, how does the accounting actually work?
So accounting standards require them to estimate the lifetime potential loss of that credit line and book it as an expense immediately.
Immediately?
Yes. It's called the Current Expected Credit Losses Model, or CECL.
Okay, CECL. Give us an example of how that plays out.
Let's say Mercado Pago gives a new user in Mexico a $1,000 credit limit. They analyze that user's risk profile, macroeconomic data, and historical cohorts, and determine there's, say, a 5% chance this specific user will default on that balance over the life of the card.
Okay, 5% of 1,000 is $50.
Right. Accounting rules dictate that Mercado Pago must take that $50 expected future loss and put it on their income statement today as a provision expense.
Even before the user has swiped the card for a single purchase.
Before a single peso of interest revenue has been collected.
Yeah.
You are front-loading all the anticipated risk while the interest payments, the merchant swipe fees trickles in over the next several years.
Wow. So when you are in a phase of hypergrowth, booking 2.7 million new cards in a quarter, you are creating an avalanche of expected future losses on paper.
An absolute avalanche. It annihilates your operating margin for that specific quarter. It makes the company look significantly less profitable than it structurally is.
Which is why the software as a service, the SaaS analogy, is so potent here.
Oh, it's the perfect analogy.
In a subscription software business, a company might spend heavily on sales and marketing to acquire a new enterprise client. And in the quarter they acquire the client, they actually lose money.
Because the customer acquisition cost is so high.
Right. But they know the client will pay a recurring subscription fee for the next 10 years, making the lifetime value vastly outweigh that initial hit.
And MercadoLibre, issuing a credit card, operates on the exact same logic.
The loan provision is basically the customer acquisition cost.
Exactly. They are happy to take the margin hit today because a credit card locks the user into the MercadoLibre ecosystem. It's the ultimate cross-selling tool.
And the data management shared proves this out, doesn't it? They explicitly noted that a meaningful share of these 2.7 million new cardholders were historically just marketplace shoppers.
Right, they were just buying stuff on the e-commerce side.
But by giving them a credit card, they are dragging them into the digital banking ecosystem.
And once they are in both ecosystems, the behavior compounds. The user shops more on the e-commerce platform because they are earning rewards or getting better financing terms through the Mercado Pago card.
And then they use the Mercado Pago card as their primary financial tool because it seamlessly integrates with their daily shopping habits.
It's a brilliant closed loop.
But it wasn't just credit cards, though. There was a subtle detail regarding their personal loan strategy in Brazil that highlights how comfortable they are trading margin for volume.
Yeah, this is really interesting.
Historically, they offered personal consumer loans with an average payback duration of 5 months. But this quarter, they stretched that duration to 8 months.
Which is a very calculated risk-reward maneuver.
How so?
Well, by extending the duration of the loan, you are inherently increasing the default risk. I mean, an 8-month window leaves more time for the borrower to lose their job or for inflation to erode their purchasing power compared to a 5-month window.
That makes sense.
And because the risk is slightly higher, the required upfront provision under those CECO rules is higher, which again compresses the margin.
Right, more upfront accounting losses.
Furthermore, they expanded their credit box, actively offering these longer loans to slightly higher risk consumer segments where the interest rate spread they capture is narrower.
Now wait. If I'm an analyst looking purely at financial efficiency, I'm screaming at the CFO right now. Why would you deliberately dilute your own margin by offering longer, riskier loans with narrower spreads?
Because you're trying to activate the dormant user base.
The dormant users.
Yeah. Think about a consumer who has received a notification offering a 5-month personal loan every week for 2 years, and they've never clicked accept.
Because they can't afford it.
Right. The monthly payment on a 5-month payback might be too steep for their cash flow. But by stretching it to 8 months, the monthly payment drops. Suddenly, the loan becomes viable for them.
Ah, so it brings them off the sidelines.
Exactly. And MercadoLibre stated that despite the higher provisioning and narrower spreads, the consumer loan portfolio in Brazil is still generating highly profitable double-digit margins.
So they are deliberately sacrificing a few percentage points of margin to capture a massive absolute increase in loan volume.
Yes, to bring fresh users into the debt ecosystem. They are trading percentage margins for absolute gross profit dollars.
It's a land grab.
A total land grab.
So we have the e-commerce strategy eating margin to build route density and the FinTech strategy eating margin to front-load lifetime value.
Yep, those are the two big pillars.
But there is a third pillar hidden in this transcript that I think fundamentally alters the long-term thesis for the stock. And it has almost nothing to do with shipping or credit cards.
Oh, you're talking about the AI integration.
Yes. Their integration of artificial intelligence.
It's a brief section of the call, but from a structural advantage standpoint, it is arguably the most significant thing they mentioned.
Yeah, MercadoLibre announced they have deployed large language models, LLMs, directly into their internal search engine across Brazil, Mexico, and Argentina.
And we need to explain the mechanics of how this changes the platform, because it's huge.
Right. For a decade, e-commerce search has been predominantly keyword-based. If a user in São Paulo types "cheap thing to keep my food cold" into a standard search bar, the keyword engine looks for listings containing the words cheap, thing, food, and cold.
And it gets confused. It might show you a cheap plastic lunchbox or a cooler bag.
Exactly. But an LLM utilizes semantic search.
Right. It doesn't just parse the words. It interprets the intent behind the query.
So the LLM understands that cheap thing to keep my food cold is just a conversational way of asking for a budget-friendly mini fridge.
Exactly. And it cross-references that semantic understanding with the user's past purchase history, their geographic location, and current seasonal trends, and immediately serves up a high-relevance listing for a mini fridge.
So the friction of discovery is eliminated entirely.
The consumer doesn't have to refine their search or scroll through pages of irrelevant results.
And the business impact was quantified on the call, which I love. The COO stated that this integration drove an immediate visible increase in conversion rates.
Yep, the percentage of people who search for an item and actually follow through with a purchase went up.
Furthermore, it drastically improves their advertising business, right?
Oh, massively. MercadoLibre allows sellers to bid on ad placement within search results. If the search engine is using an LLM to deliver hyper-relevant results, the ads placed alongside those results are naturally more aligned with the consumer's intent.
So the click-through rates on those ads increase.
Exactly. The return on ad spend for the merchant improves. And when merchants see better returns, they bid higher for the ad slots, driving high-margin advertising revenue directly to MercadoLibre's bottom line.
And this is not a theoretical white paper project. This LLM architecture is live right now across their 3 largest markets.
It's fully deployed.
They explicitly tied it to that 49% top-line growth and a full 1 percentage point increase in conversion rate in Brazil.
And in an e-commerce ecosystem generating tens of billions of dollars in GMV, a 1% improvement in conversion rate is an astronomical amount of absolute revenue.
So true. All of which leads us directly into how management is framing the future. Because when you synthesize the free shipping logistics, the aggressive loan provisioning, and the AI deployment,
the resulting 6.9% margin is clearly a symptom of intense reinvestment.
Right. The question is, how does management communicate this to a Wall Street audience that is inherently impatient?
The tone of the management team was borderline defiant, honestly.
Defiant.
Yeah, they used a specific phrase multiple times on the call. Setting the dial. One of the analysts, Jeffrey Elliott, actually pressed them on this. He noted it's highly unusual for a management team to be so blunt about controlling their own profitability.
And what did the CFO say?
His response was a massive flex of structural leverage. He essentially told the analysts, look, if we wanted to print a 12% margin tomorrow and make you all happy, it would be fairly easy. We can simply stop issuing 2.7 million credit cards a quarter, and we could raise the free shipping threshold back up to 50 Rs.
Wow. So the 6.9% margin is not a result of external pressure at all.
It is entirely an internal choice. They have deliberately set the dial to hypergrowth, and they explicitly warned investors not to expect that dial to turn toward margin optimization anytime in the near future.
Because they see a multi-year runway across Latin America. Their unit economics, like that 17% drop in shipping costs, prove their thesis is working. So they refuse to take their foot off the gas.
Exactly. And if we look forward, we can see exactly where that capital is being deployed next. The most immediate catalyst is in Brazil, with the imminent launch of private payroll loans.
Okay, let's talk about that. The Brazilian payroll loan, known locally as Crédito Consignado, is a massive financial instrument down there, right?
It is entirely different from a standard personal loan. With a payroll loan, the monthly repayment is deducted automatically from the borrower's paycheck by their employer.
Before the money ever reaches the borrower's bank account.
Exactly. The lender gets paid first, mathematically eliminating almost all voluntary default risk.
That's incredible.
The only real risk is if the borrower loses their job entirely. Because the risk is so heavily mitigated, the interest rates are lower, making it highly attractive to the consumer. But the default rates are near zero, making it incredibly stable for the lender.
And MercadoLibre confirmed on the call that they have already completed the complex integration with the Brazilian government and payroll systems to roll this product out.
They're ready to go.
So it gives them a massive, stable, low-risk credit asset to balance out the higher-risk personal loan expansion we discussed earlier. It solidifies their balance sheet.
It really does. And beyond Brazil, the other major catalyst is Argentina. They began issuing credit cards there in August and September of last year.
But Argentina requires a completely different operational playbook, right? I mean, it is a notoriously complex macroeconomic environment characterized by extreme inflation and currency devaluation.
Lending money in that environment is historically treacherous. But MercadoLibre possesses a structural advantage that traditional Argentine banks do not.
Absolute principality of data.
Exactly.
So explain how that data advantage mitigates the macroeconomic risk in a place like Argentina.
Okay, so because of the inflation in Argentina, consumers use their Mercado Pago digital wallets as their primary financial operating system.
Because they don't want to hold cash that's losing value.
Right. They receive their salary, immediately move it into a Mercado Pago money market fund to earn daily interest and protect against inflation, and then use the app to pay their utility bills, buy groceries, and transfer money to friends.
Meaning MercadoLibre sees every single transaction.
Every single one. They know exactly how much liquidity a user has. their spending velocity, and their reliability.
Whereas a traditional bank relies on static credit scores that might be 6 months out of date.
Exactly. MercadoLibre relies on real-time daily cash flow analysis. They use that proprietary data to underwrite the credit cards, ensuring they only issue lines of credit to users with proven, verifiable liquidity.
And the management team reported that the early cohorts, the repayment behavior of those first batches of Argentine credit cards issued late last year, are performing exceptionally well.
The data trends are mirroring the highly successful rollout they executed in Brazil years prior. They have figured out how to safely underwrite credit in one of the most difficult economies on the planet.
But we have to address the competitive threat. I mean, no matter how good your algorithms are or how deep your data goes, if a global titan decides to buy the market, you have a problem.
Yeah, that's the 800-pound gorilla in the room.
Right. An analyst brought up the reality that Amazon is ramping up its investment and focus heavily in Brazil. Did management express any concern about a potential price war eroding their market share?
The response from Ariel, the COO, was incredibly confident. He directly addressed the Amazon threat by stating, "We thrive in competitive environments."
He didn't seem panicked at all.
Not at all. He didn't dismiss Amazon, but he reframed the impact of their presence. His argument is that when a competitor like Amazon pours hundreds of millions of dollars into marketing and logistics in Brazil, they are largely doing the heavy lifting of educating the market.
They are paying the cultural acquisition cost to convince offline retail shoppers to trust e-commerce.
Exactly. In Latin America, e-commerce penetration as a percentage of total retail is still significantly lower than in the US or China.
So the total addressable market is not a fixed pie.
Amazon's marketing spend expands the pie. It brings new consumers online. And once those consumers are online, MercadoLibre's underlying metrics suggest they eventually migrate to the platform with the best prices, the fastest shipping, and the integrated financial tool.
And the data backs up that confidence. Even with Amazon pushing aggressively into Brazil, MercadoLibre's internal metrics are strengthening. Purchase frequency is accelerating. Cross-category shopping, like buying a t-shirt and a power drill in the same session, is increasing.
And as we established earlier, their overall conversion rate grew by a full percentage point.
So Amazon is expanding the borders of the market, and MercadoLibre is simply conquering the newly available territory.
Which brings us to the verdict.
Yeah.
When you consolidate the headline numbers, the strategic sacrifices, and the management's unapologetic posture, how do you synthesize this for the retail investor?
The conclusion has to be aggressively bullish. If your analysis stops at a headline reading, MercadoLibre operating margins drop to 6.9%, you are failing to read the board.
You're missing the whole picture.
The Q1 2026 earnings demonstrate a company executing a masterclass in ecosystem lock-in. The margin compression is a calculated weapon.
It's funding the 19 Regas shipping thresholds that drive 56% volume growth and 17% lower unit costs.
Exactly. And it is funding the loan provisions required to issue 2.7 million credit cards that trap users inside their financial walls.
So for you, the investor currently holding the stock, the actionable takeaway is to ignore the noise surrounding the cost of risk.
You will see analyst notes warning that Miliai's cost of risk increased to 37%. You must understand that this is the mathematical reality of expanding a highly lucrative high-yield credit portfolio by 87% year over year under those CECL accounting rules.
It is not a sign of a deteriorating consumer base. It is the upfront cost of locking in a decade of interest revenue. Do not let a misunderstood accounting provision shake you out of a dominant position.
And if you are on the sidelines considering an entry point, you are looking at a business with a moat that is widening at an accelerating pace.
The logistics network is hitting a scale where higher volume actively drives down marginal costs.
The merchants are locked in by conditional take rate discounts, and the consumers are seamlessly transitioning from buying phone chargers to taking out personal loans within a single app.
The holy grail of modern retail is the seamless cross-pollination of e-commerce and digital banking. Very few companies globally have achieved it, and MercadoLibre is executing it flawlessly across incredibly complex, dynamic emerging markets.
As we close out this analysis, I want to pivot back to a thought that expands beyond the immediate quarter. We have spent this deep dive dissecting logistics algorithms, loan provision mechanics, and free shipping psychology. But think about the quiet deployment of that large language model search engine.
Yeah, the AI piece. It is the unseen architecture beneath everything we've discussed today.
Consider the sheer density of the data advantage MercadoLibre has amassed here. They're operating in regions where traditional financial data like FICO scores or reliable credit bureaus is often fractured or just completely non-existent.
But MercadoLibre doesn't need a credit bureau.
No. They know exactly what an entire continent is typing into a search bar. They know the semantic intent behind the search. They know if the user ultimately bought the item.
They know if they paid with cash, or a digital wallet, or a credit card.
And they know the exact duration it took them to repay the loan to fund that purchase.
They own the transaction from the initial spark of consumer desire all the way through the settlement of the debt. The LLM isn't just making search easier, it is training itself on the most comprehensive closed-loop data set of consumer behavior in Latin America.
In a global technology landscape where artificial intelligence models are ultimately constrained by the quality and exclusivity of the proprietary data they're trained on, MercadoLibre is sitting on a goldmine.
Competitors can build warehouses. Competitors can subsidize shipping. But competitors cannot replicate the behavioral and financial data of hundreds of millions of Latin American consumers.
Could it be that in 10 years, we don't look at MercadoLibre as an e-commerce platform or a digital bank, but as the ultimate, unassailable AI predictive engine for emerging market economies?
It forces you to completely reevaluate the scale of their ambition. They aren't just facilitating transactions, they are predicting the economic pulse of an entire continent.
It changes the lens entirely. What looks like an inefficient 6.9% margin to a short-term trader is actually the cost of building a structural monopoly that cannot be easily dismantled. You just have to know how to interpret the data beneath the headlines. Thank you for joining us on this deep dive into MercadoLibre. Keep questioning the consensus, look at the unit economics, and as always, keep your portfolios sharp.